4 years ago, Bitcoin was a joke. It's no longer a joke. For the common person on the street, I think it's just how foobarred the fiat system is and all the wonderful things you get with Bitcoin. The reason gold rallied is that central banks started buying gold in 2022 after the US seized Russia's treasury assets. Central bank purchases went from 400 tons to 1,000 tons. So I think it like 5x'd. And that just exhausted supply, and they've been doing it every year. And central banks aren't buying Bitcoin. I think they will, but they're not buying Bitcoin today. And so Bitcoin has been dominated by the classic 4-year cycle, which is a pullback year. It happened to coincide with the year that central bank purchases continued to ramp. Central banks on gold, the 4-year cycle on Bitcoin. That's why the market did this, but nothing's broken on Bitcoin. The world is more digital every day.
Matt Hougan begins by addressing a question that has puzzled many investors: why Bitcoin declined sharply while gold surged to new highs. Rather than viewing this divergence as a failure of Bitcoin's digital gold thesis, he argues that the move can largely be explained by two powerful forces shaping the market at the same time: the traditional 4-year Bitcoin cycle and an unprecedented wave of central bank demand for gold. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
I think the reason Bitcoin collapsed was that people who held a lot of Bitcoin sold their Bitcoin in anticipation of the 4-year cycle, either directly or by doing option overlay strategies against it. But maybe that's the paper element. That's part of why you don't see so many sales in the on-chain data, because a lot of it was option overlay strategies. But it's the same effect. It's people who were long Bitcoin who decided to sell away the upside, and that's why the price collapsed. The reason gold rallied is that central banks started buying gold in 2022 after the US seized Russia's treasury assets. And you can see it in the data. Central bank purchases went from 400 tons to 1,000 tons, and that's just reported. That doesn't include most of China's buying. So I think it like 5x'd, and that just exhausted supply, and they've been doing it every year. And central banks aren't buying Bitcoin. I think they will, but they're not buying Bitcoin today. And so Bitcoin has been dominated by the classic 4-year cycle, which is a pullback year. It happened to coincide with the year that central bank purchases continued to ramp. And I think that's just a simple explanation. Like, there are these idiosyncratic effects: central banks on gold, the 4-year cycle on Bitcoin. That's why the market did this, but nothing's broken on Bitcoin. The world is more digital every day. The world is losing faith in institutions every day. The world is worrying about fiat currencies more every day. Young people are getting older and richer, and they grew up with Bitcoin. That happens every day. So the long-term story is still intact. So I think you can explain away the gold move pretty easily. Every market, so gold and silver for sure, but also stocks. The derivatives market on stocks is much bigger than the physical market on stocks. And again, I think in the short term you can have unusual effects. I definitely think it's the case that people look at the leverage order book on highly levered futures exchanges and think about creating cascading liquidations. I think that's objectively true. But I do think in the end, when you work out the math, when you think about like demand is +1 and shorting is -1, the futures, the paper Bitcoin settles ultimately to physical demand in the long term. So I do think that's the case. Now, in something like October 10th, are there strange dynamics in the option space and how options react to increasing volatility that can create sort of serial autocorrelation, which is to say, because something starts moving, it continues to move down. That's definitely true in the short term. So I want to make clear that these can have meaningful short-term effects. But in the long term, it settles out to physical Bitcoin. So could October 10th have been made worse because of the unique characteristics of the options market and what you're referring to? Definitely. But is that the reason we're down 50% since October 10th? Definitely not. The reason we're down 50% is a bunch of people sold their Bitcoin. That's like over the long time frame, that is the issue. In the short time frame, as you get more derivatives and more leverage, you can have sort of autocorrelation that moves things in a continuing direction.
How big of an impact do you think the entire gold move has done on Bitcoin in the short term?
Yeah, I think it's had a significant impact. in two ways. So one, when I think about like Bitcoin investors, I think of a couple different groups. I think of hedge funds doing complex macro trades. I think of long-term investors that are buying and hodling, whether they're individuals or institutions. But then there's like this attention economy. And these are people who are chasing after the hottest thing. And it used to be crypto, and that's a big market. And now it's gold and AI. And we've sort of lost that attention economy. So I think that that's been a big factor. And then I do think, even though there is a really good explanation for why gold went up and Bitcoin went down, like a really simple explanation, the fact that that happened created a narrative break in people's minds. So like when I go out and I meet with institutional investors, they start to ask me, why is Bitcoin down when gold is up? I thought it was digital gold. And even though you can explain it, it takes time, it slows down purchases, it slows down the process. So I think there's this narrative disconnect, which is going to make the bottom of this bear market more extended as people have to wrestle with why that happened. The other thing that's just intuitively obvious is that as the gold market gets bigger, the TAM that Bitcoin is going after is also bigger. It's a sign that there's more demand for store of value. To make that concrete, I remember when the gold ETF launched in 2004. I was in the ETF space. The whole gold market then was $2.5 trillion, right? So Bitcoin is what, 1.5-ish right now. The whole gold market when the gold ETF launched was $2.5 trillion. Imagine if Bitcoin were saying it's digital gold and its addressable market was $2.5 trillion. We wouldn't be very bullish, right? We would say it already has like 60% of the market. Like the fact that we're now at $30+ trillion gold is hugely positive for making the long-term case for Bitcoin. It shows that the store of value market is probably going to be $50 or $100 trillion pretty soon. And Bitcoin will take its share of that. So I think that that's positive long-term. And I agree on a short-term basis, look, these trends will come back together. Bitcoin's more attractive right now than gold from an upside perspective. Maybe it would help to explain what I mean when I don't think paper Bitcoin is a problem, because I think there's some interesting edge cases. I think Jane Street is an interesting edge case. So I don't want to say that I'm like, everything's perfect. That's not what I'm saying. But let's think about a classic case of paper Bitcoin. Let's say there is somebody who wants to get long Bitcoin, right? That's what we all want. We want more people owning Bitcoin. And they have a choice. They can either buy physical Bitcoin, spot Bitcoin, or they can buy a Bitcoin futures contract, right? And let's say they decide to buy a Bitcoin futures contract. That's the paper Bitcoin concern, because they want long Bitcoin exposure, but they bought a futures contract instead of buying physical Bitcoin. That's what we don't like. But the reality is, on the futures contract, they went long and someone else went short, right? That's the way futures contracts works. There's two sides to every contract. So someone went long and someone went short. The person who went short, in nearly every case, hedged themselves by being long physical Bitcoin. The reason they sold that contract short is that the futures trades above the spot price of Bitcoin. And so they're able to collect the difference between the premium of the futures and the spot Bitcoin. And what that means is at the end of the day, we had somebody who wanted to go long Bitcoin and they bought a futures contract and someone sold a futures contract to them, but then that person had to go long Bitcoin on the other end of the equation. So it mostly trickles down. Now, where it doesn't trickle down to physical demand, which is ultimately what you want, is when you have things like settlement delays, or when you have things like naked shorting and things like that. Then you can get short-term periods where demand doesn't translate into physical demand. It's just over like weeks or months, it all trickles down in the end. It can't continue to spiral. It all trickles down. That's why, people worry about ETFs. ETFs bought a lot of Bitcoin, right? So it does all trickle down. On the micro movement question, you can get this effect, but it does ultimately end up in physical Bitcoin, is my view.
Even if the divergence between Bitcoin and gold has a logical explanation, Hougan acknowledges that it has created a narrative challenge for the cryptocurrency. For years, Bitcoin has often been described as digital gold. When gold rises while Bitcoin falls, that narrative naturally comes under scrutiny.
You now have people that these people, for good reasons or bad, respect, talking about Bitcoin all the time, right? You have Larry Fink talking about Bitcoin, the CEO of BlackRock. You have Kevin Warsh, the incoming Fed, saying if you're under 40, Bitcoin is your gold. You have Ray Dalio saying, 15% gold and Bitcoin. These are the sort of thought leaders that these people need to gradually turn the tide on Bitcoin. From my perspective, it's happening. The people I talk to, who are the institutional investors who control the money, 4 years ago, Bitcoin was a joke. It's no longer a joke, right? So actually, though, maybe not the common person on the street, but the people with the money, it's a positive news story. For the common person on the street, I think it's just continued education about how foobarred the fiat system is and all the wonderful things you get with Bitcoin. But that's just a process. I will say for the money managers in the world, Bitcoin's reputation is much better than it was at any time that I've been involved full-time in the space. So I've been doing this for 8 years. It's in a better place now than it ever has been.
If quantum compute is a risk for Bitcoin, it's actually a risk for everything, and Bitcoin is the least of your problems. How do you see that entire topic at this point?
I think that's exactly true. And yet, I think it is slowing down the growth of Bitcoin. The reason, from my perspective, I can only speak to the people I speak with, right? The traditional investors who are considering Bitcoin. The reason it slows that down is, even though what you said is true, and even though I feel very confident Bitcoin will solve quantum, when I go speak to an investment committee of like 6 guys who decide whether this $10 billion RIA allocates 2% to Bitcoin or not, it has to go through a committee in most cases. There'll be one guy who'll raise his hand and say, what about quantum? By the act of raising his hand means we have to talk about how Bitcoin improvement proposals work. And we have to talk about Bitcoin core developers. And we have to talk about the quantum threat. And we have to talk about Satoshi's wallets. And we have to talk about whether the community will solve all the edge cases on. And that just takes time. Even if they're good answers, it takes time. So someone who would have allocated is now allocating 9 months later, because it's going to take 9 months to resolve that sort of fear, uncertainty, and doubt at these institutional levels. That's why it matters. So even though, Lynn, even though what you said is right, we're going to solve it. And if we don't solve it, we should worry about the nuclear codes, not our Bitcoin. If you ran a data center and you were doing one thing, which was Bitcoin mining, and it had one profitability payoff, and then someone was like, you could do some of yours, put some of your assets toward AI, and it has a better profitability payoff. You're a profit-seeking human, you will do that. The reason I don't worry about it is it's naturally self-correcting. If enough miners pivot to AI, then the difficulty will fall, and the cost to mine will fall, and the price of Bitcoin will go up, and you'll be able to print massive profits. The beauty of if you think back over the last 16 years, think of all of the threats that people have raised to like Bitcoin mining sustainability. They have been many, right? There have been nation state threats. There's like the period where we moved all the miners out of China, and with Bitcoin, there's been an infinite number of these stories. But the brilliance of the system is it's self-correcting economically. So if everyone pivots to AI mining, I'm going to spin up a Bitcoin miner in my house and make money, right? And because of that process, it'll be fine. So I think it'll happen. You can even see it maybe in the hash rate right now. But it's self-correcting. It has been for 16 years. It will be for the next 160. And so I ultimately don't worry about that.
If we look at AI, what type of impact is it going to have to the economy in general?
The short answer is no one knows precisely, of course. But the fun thing is, when you reason them out, they basically all lead back to Bitcoin. So there's a few worlds that you can imagine. One is where it's not as disruptive as we think. It just makes us slightly more productive, and Salesforce doesn't go to zero. It actually becomes more productive, and the economy does well. That's pretty good for Bitcoin because it's a risk-on asset, and we want the market to generally be positive. Okay. The other is this doom scenario where it takes all the jobs, it's massively deflationary, they're nowhere to work, and we're all, very wealthy but have nothing to do. And we wouldn't spend money because prices are going down. But the government reacts to every instance of deflation by just pumping money aggressively into the ecosystem, which inflates asset prices, and that will happen here too, right? Bringing China into the WTO was deflationary as well, and we responded by printing infinite amounts of money, and that sort of set the conditions for Bitcoin to launch. COVID was massively deflationary. We responded by printing infinite amounts of money, and that was very good for Bitcoin. If AI is like max deflationary, we're going to respond by printing infinite amounts of money because we can't have deflation in our economy, and that will be good for Bitcoin. And then my base case really is what's going to happen is basic disruption. So AI is going to disrupt a lot of SaaS businesses, and the value will be captured by AI companies and then by companies who previously overpaid for SaaS services, and the world will just be better and richer. I think that's like the most likely case. And I think that's fine for Bitcoin as well. So I don't believe in the doomerist scenarios as my base case.
While Bitcoin's recent price decline has raised questions among investors, Matt Hougan argues that the underlying explanation is relatively straightforward. The combination of a traditional 4-year crypto cycle, strategic selling by existing holders, and unprecedented central bank demand for gold created a temporary divergence between Bitcoin and traditional safe haven assets.